Hi, this is Ron Cipcic. This is the second part of a two-part series on international trade. In this particular episode, we're going to continue our flatland, hillland example. In our first part, we showed that two countries can benefit by engaging in international trade. That is, they can specialize and then produce a product, one country buying that product, another country selling that product, and we showed that countries can be made better off by doing that. We also showed, however, that there are winners and losers whenever international trade takes place. The importer wins and loses. The exporter wins and loses. Let's go to the importer case. Just a reminder, in the importing case, the consumer wins because they pay less and are able to buy more. But in the importing case, the producer loses because that is the producer who is competing against imported product because they take less for the product and they actually sell less. And in the exporting case, we showed that the producer, the producer is the companies that actually export product, they win because they're able to charge more and sell more, whereas consumers in the exporting country actually lose because they pay more and they actually buy less. What we're going to show in this second part is that the winners actually win more than the losers lose. So in the end, whether you're an importer or an exporter, from a welfare standpoint, you're actually better off. And we did not make this case in the first part. We're going to make it now. Before we actually go into the arguments, we need to review a couple concepts. When you look at basic market theory using a supply curve and demand curve, if you identify the area below the demand curve and above the price line, you actually are identifying an area called consumer surplus. Now, consumer surplus represents the value the consumer receives but doesn't pay for. So whatever the price is here, the consumer, by paying that price, actually pays for some of the value the consumer gets. But again, remember, the demand curve represents the highest price the consumer would pay and still buy it. So if you shade in the area below the demand curve and above the price line, you actually shade in an area called consumer surplus, and this is an area that is of benefit to the consumer. Now, if you shade in the area below the price line, let me just go this way, and above the supply curve, you're actually shading in an area called producer surplus. So let me go ahead and get that shaded in, and then I'll make a note over here. This is called producer surplus. Producer surplus is value the producer receives above what is required to produce the product. So the supply curve shows the minimum price that has to be paid to get a producer to bring the product to market. But you can see that on most of the units, the producer actually receives a price above that minimum. And that area is called producer surplus. Again, it's value the producer receives above what is required to bring the product to market. Now, if you combine those two areas, if you take consumer surplus and you add it to producer surplus, you actually get an area called societal surplus. So societal surplus is simply the sum of consumer and producer surplus. Let me write out the term here for you. Societal surplus. And societal surplus is a good thing. After all, it represents a situation where both consumer and producer are winning. And this is a very key concept when you're discussing trade, be it between individuals or be it between nations. That whenever two individuals, or if you want to expand it out to two countries, whenever they trade, both consumer and producer win. They both benefit. And of course there's some assumptions behind this. One assumption is that both consumer and producer have information about the product, that they're not buying something or selling something, and the other party is confused about what they're either buying or selling. And then secondly, we assume that there's no duress. In other words, there's no, the deal has not been brought about because of force or some sort of pressure. In other words, we assume the trade is voluntary. So whenever two parties trade, again, assuming they both have sufficient information to make that trade and assuming that there's no force or manipulation or pressure being put on the traders, then we can assume that both consumer and producer walk away from the deal winning. All right? Now, we want to take these ideas and we want to apply them to our international trade problems. So I'm going to actually move this canvas, and I'm going to resume discussion of flatland and hillland. So let me get down here. I've set the models up already so we can get going right away here. Now, just a quick speed review. Notice that I have switched the product from grain to metal in this example, and I've given you domestic prices. Let me get rid of the little moving icon there. We're assuming in flatland that flatland is the importer, and how we can tell that is the supply curve is way over to the left. It is a high-cost, low-tech producer of metal, and we assume the price of metal is relatively high in flatland, $40, and we assume that the production rate is relatively low in flatland, only 4 million tons of metal. Whereas hillland's supply curve is way over to the right, and therefore it represents a case where hillland is the low-cost or high-tech or both producer of metal. And because the supply curve is way over to the right, the price is relatively low and the production rate is relatively high. So all of the principles that we laid out in the grain example apply here. Now, as we said in the grain example, the buyers over here who are paying a relatively high price would be attracted to metal over here because it's relatively low. Sellers who are selling metal in hillland for a relatively low price would be attracted to the flatland market because prices are higher. So again, there is opportunity here for arbitrage, where somebody takes a relatively low-priced product and sells it or moves it into a market where prices are relatively high. There are profit opportunities for international trade here. And again, if the governments of hillland and flatland permit international trade, permit their citizens to interact, well, this is going to occur. That profit will drive sellers to seek out these buyers, and buyers, because they're trying to get the lowest possible price, will seek out sellers internationally. Now, as we said last time, the world price has to fall somewhere in between the two domestic prices. So let's go ahead and draw in. Let me use a different color here. We'll use midnight blue. We're going to draw in a dotted line, which is really a reference line showing where the world price will fall. And let's say the world price is 20 over here. We have to draw in a price that's below the domestic price, which is 40. And so this is PW. Okay? PW is our world price. Now, remember from our example last time that 1 F dollar has to equal 2 H dollars. That was the given exchange rate for these currencies. So if we have $20 over here as the world price, then over here the world price has to be $40 in H dollars. So PW is $40 in hillland. Again, we maintain that 20 to 40 relationship, or that 2 to 4 relationship, or that 1 to 2 relationship that we introduced in the grain example. Now, as we've said, in the importing nation, flatland will be the importer. It's going to want to buy metal from hillland because it can get metal cheaper from hillland than it can make it at home. The effect of that, of course, is to push down domestic production, as we said in the grain case. Let's say this is 1.5 million tons, but because the price has dropped, buyers are going to be very interested in buying more metal. Metal is cheaper. Let's say this is 6.5 million tons. And again, the importer runs a what? Runs a shortage. So here's the shortage that we discussed back in the first part. Now, the price rises in the exporting nation, so the exporting producers are going to be inclined to want to sell more. Higher prices motivate greater production. Let's say this is 15 million tons. So metal producers are going to want to increase their production. On the other hand, buyers of metal in hill land are going to find metal to be more expensive, and that's going to motivate them to actually buy less metal. And so the higher price creates, as we said, in the exporting nation, a surplus. And so we'll just label that in there. Okay? Now this is all review. I'm simply reviewing the things that we talked about in our last example, the grain example. And of course that surplus, we're assuming that surplus gets exported. So it finds its way over here and it's actually going to fulfill this shortage. So when you add together the production of hill land plus the production of flat land, you get 16.5 million tons of metal produced. You add together the demand of hill land, 10, plus the demand in flat land, 6.5 plus 10, you get 16.5 million tons demanded. And as we argued in the first part, these international markets move towards a world equilibrium. And so, sure enough, our metal example is in equilibrium. Now again, all these points were made in part 1. I don't want to rehearse all of those points again in part 2. If you don't remember some of those concepts, you'll want to go back to part 1 and watch the video again. Now, let's use our consumer producer surplus model to shade in some of the areas on our diagram. So let me use a different color here. I'll use red. And I'm going to label this area right here A, this area right here B, this area here C, and this little area right here is going to be D. Okay? And I'm going to take green over here, and I'm going to call this area here A, this area here B. B will actually capture this entire area right here. Okay? And then area C will be this area, and then area D, we'll put D in here, will capture this entire area here. Okay? All right. So let me just make sure we've got these areas clearly identified. Here's A. Here's B. Here's C. Here's D. D is this little area here. And then I better not put red on there. A is this area here. And then so on. Okay. Now, what we have done is we have actually labeled the areas in such a way that we can identify consumer and producer surplus both before and after trade. All right, so here's what I'm going to do. I'm going to go down and I'm going to set up tables so we can evaluate consumer and producer surplus both before and after trade. So let's do that. Let's pull our little canvas moving device down. I'm going to move these up. Okay, and we'll get rid of that. And let me go back to black. Okay, so here's what I'm going to do. I'm going to first of all set up a table on this side for the importer of metal. Okay, so let's do that. And we're going to have 3 major columns. And this is going to be consumer surplus, producer surplus, societal surplus, no trade, and then here we're going to have trade. It's an R. Okay, and that's a D. Okay, and this will be net effect here. Okay, So what happens in the importing nation? Well, the consumer, before trade occurs, let's take a look at this. Before trade occurs, the consumer is getting what? I better get rid of that. The consumer is getting above the price line, below the demand curve. So the consumer is getting letter A. The producer, when there's no trade, again, when there's no trade, the price is 40 and the output rate is 4. The producer is getting below the price line, above the supply curves. So the producers are getting B and D. So let's go down. We'll put that into our table. So consumers get what? Consumers get A when there's no trade. Producers get what? Producers get B and D. So society gets A, that's an A, B, and D. Okay? Now, after trade, it's not quite as clear. Let's go back up there and look. After trade, be careful. Consumers actually get what? After trade, let me get rid of that. Consumers actually get, if I can move up there, consumers get A, B, and C. Why? Because they actually get above the price line, which is 20. They get above the price line, and they get what? Below the demand curve. So consumers get A, B, and C because consumers consume all the way out to 6.5 right here. Consume all the way out to here. So consumers are getting above the price line, below the demand curve, out to 6.5. Okay? So the consumers will get A, B, and C. Now look at this. Producers get below the price line, 20, above the supply curve, out to where they produce 1.5. Producers only get what? Area D. So let's go ahead and fill that into our table. We're going to have to do a little get my canvas straightened up here, and very interesting way to move the canvas, don't you agree? So let me go over here, let me get rid of my canvas moving device and get the right color going. So what are consumers getting? Consumers are getting A, B, and C. So consumers are up what? They're up area B, and they're up area what? They're up area C. Producers, on the other hand, only get area D. Only area D, which means they lose B. Society ends up, remember societal surplus is consumer plus producer, so society ends up with A, B, C, and D. Society is up area C. So in essence, what happened here is the gain in consumer surplus is greater, look at plus B plus C, is greater than the loss of producer surplus. Therefore, the three points there mean therefore there's an increase in societal surplus. Societal surplus actually increases in the importing nation. Another way to say this is that the consumers won more than the producers lost. Look at the transfer of wealth from producers to consumers, but consumers also picked up this additional area C. So the consumers win more than the producers lose. Therefore, there's a net increase in societal surplus. Importing actually overall benefits the nation. Now that, you don't hear that talked about a lot. That's not common knowledge. Okay, now let's do the same thing. This is the importer over here. In this case, we're talking about Flatland, who is the importer of metal. Now let's set up our table. I'll move this over a little bit. Let's set up our table for the exporter. So here we go. 1, 2, 3 columns, and then we're going to again set up some rows here, and we'll show the comparison. So consumer surplus, producer surplus, societal surplus, no trade, trade, net effect. I hope you're taking notes with me, not just watching this. If you are just watching it, it's better than nothing. But if you learn to write these things down, they'll go deeper into you. Okay, now we need to go up and look at the diagram. So let's do that. Let me get my positioning device here. Now, when there's no trade, the price is what? The price is 20. Let me get rid of that. When there's no trade, the price is 20. That's the no trade price right there. What do consumers get? Consumers get above the price line, below the demand curve. The demand curve is over here. The demand curve is up here. So below the demand curve, above the price line, consumers get what? A and B. What do producers get? They get below the price line, above the supply curve. Now this area is cut off here, but it's okay. So below the price line, above the supply curve, producers get area what? Area D. So let's go ahead and click on that. Bring our, and we're going to move back up here. So what do consumers get? Consumers get A and B. Producers get what? Producers get what? Producers get D. So society gets A, B, and D. Okay? Now, let's go back up. Let me get my device in place. Move this down. After trade, the areas change. The areas change. After trade, the price is 40 and the rate of production is all the way out to QS. Look at that. So producers get below the price line, above the supply curve, out to where they produce, and they produce all the way out to here. So producers are going to get areas B, C, and D, this entire area, because they produce out to 15 million tons. Consumers, on the other hand, because the price rose, they're getting above the price line, below the demand curve, out to 10. Remember, consumers are demanding less, so they're only getting area A. So let's go ahead and fill our table in. And what are consumers going to get? Let's just get rid of that. What are consumers getting? Sorry, my pen, there it is, came alive. Consumers are only getting what? Consumers are only getting area A after trade. So they lose area B. Producers, on the other hand, are getting B, C, and D, which means they're gaining B and gaining C. Society ends up with the sum of that, so A, B, C, and D. Society ends up gaining area C. So what we see here, think about this, the gain in producer surplus is what? Greater than the loss of consumer surplus. Here's the loss of consumer surplus. Therefore, there's an increase in societal surplus. So the exporter, while it has a winner and a loser, the winner wins more than the loser loses. And guess what? The exporting society actually wins. So is exporting good for a nation or bad for a nation? It's good and bad. But the win or the benefit exceeds the loss. So the winners win more than the losers lose, and so the exporter nets out winning. Contrary to the mythology around importation, the importer actually wins because the gain to consumers, look over here, I'll change my ink color, the gain over here to consumers exceeds the loss that producers incur Therefore, there's a net societal gain from importing. So again, there's winners and losers in each country, but both countries win by trading. Now, this model is incredibly important. It not only shows us, let me change my marker color here. I'm going to pull a different marker color in here. But it shows us how things move from no trade to trade, obviously, and that's been really the focus of this example. But it can also show us what happens when trade is banned. All right, so for political reasons, let me go ahead and make myself a little bit more room here. For political reasons, countries will sometimes ban trade. Well, you can see from this model that there will be winners and losers from a ban on trade. If one of the governments, if the government, I'll just not pick one, but if government were to ban trade between hillland and flatland, say trade, this would be metal trade. Now you could do the same thing. You could do the same thing for hillland and flatland concerning grain, but let's just think this through. If there's a ban on trade, how would that impact hillland, who is exporting metal? Well, hillland, the exporter, would find that its producers lose more than its consumers gain, and therefore there would be a loss of societal surplus. So, you can see how trade affects hillland when it exports metal, but you can also see how anything that inhibits the trade of metal from hillland to the world would impact. Metal producers would be hurt. There'd be a loss of employment, perhaps in that industry. However, consumers in hillland would end up paying less because they wouldn't have to compete with consumers in flatland for hillland metal. But overall, society would lose from that. If the government were to ban the trade of metal between hillland and flatland, how would the importer be affected? Well, consumers of metal would be hurt more than the producers of metal. Domestic producers of metal would be benefited, and there would be a net loss of societal welfare in flatland. Flatland would be hurt by this. Now, for political reasons, maybe the government in flatland wants to protect domestic metal producers. And so politically, this might save some jobs in the domestic metal industry and might get some people elected who represent those metal industries. But consumers of metal are going to end up paying a lot more for metal in flatland because they can't import it. And then, of course, over here, you're going to have just the opposite effect. So the beauty of this model is that once you learn how things move from no trade to trade, and you understand the winners and losers and all that, and are able to kind of lay out the dimensions of those winnings and losings, you're then able to look at the model from the standpoint of, well, what happens if we move from free trade back to restricted trade or no trade? In other words, there's a ban on trade. All right, this ends the second segment in our series, International Trade.